Ladies and gentlemen of the crypto space, we're live on Friday, June 2nd at 11:48 a.m. Serve the memes, protect the left curve, uphold the yield. I don't know. It's a good thought, and that's what we do. Hopefully everyone passes that along, and then we could all do a little bit better as a population. Also put on Twitter, we will all cope, and we will like it. Might as well learn to cope better. So isn't that really a great distillation of the process? We all know destination. We know the path that things will take, and conditions indicate there's going to be a fair amount of coping in the short term, short probably even to midterm, but long term, 1 year out. There's only one way that the calculations actually crunch, and we really know the destination. So let's try and continue to serve the memes and protect the left curve. And we sure as hell respect the yield. Appreciate all of you joining. Dan's in the house. Do you have any thoughts on the phrase crypto's relative strength, like an RSI, relative strength index? No, no. Strength. There is significant strength in the crypto space, and there's all the narratives we talk about. It's outside money, as Arthur Hayes talks about. It's a market directly accessible to all countries rather than vis-a-vis a particular country. And that is extremely significant. You don't have to go through New York to get to a particular market if you're in Europe. You go directly from your respective sovereign nation to crypto markets. And you can access this shit anywhere, period. It's just little friction as compared to traditional finance, as I've been highlighting so memorifically on Twitter. My experience last night with the banking system. The frictions are horrible. It took hours to do anything. What an absolute disaster in the making. The mitigation, the elimination of frictions changes everything. And it's not just Fed now. It's not just the improvements that can be made with their processing vis-a-vis, centralized infrastructure. It's literally just the websites. It's their individual tech stacks are just not deprecated. They're just antiquated. Maybe they were never good. So can they be antiquated if they were never good? They're just shit. So that's what people are forced to use. And I guess, what is it? You don't even know there's better. That's why people don't even know their banking software is shit, because they don't know there's better. There's no relative comparison to be made. But anyway, isn't that the case? When's the last time you logged into your banking app on the web and were like, oh, this is innovative and exciting? So, this is a period of cope. This is a period of what? 2019? It was all cope. Late 2018 feels sure as hell like a 2022. And this is a period of just no capital inflow. We look at the liquidity, the domestic liquidity on Ethereum mainnet. We look at the marginal markets as well, but mainnet is the primary place to look for liquidity conditions. And it shows a net zero sum, if not marginally negative sum game. We see the macro indicators in just screaming that everything's broken, shit's going to explode. But the question in everyone's mind is, how do we cope? We know the path, we know the destination, and we have to cope with the risk, the fear associated with the short term capitulation, the short term volatility. It's going to come. But this is actually quite interesting how Move seems to be topping. This is quite toppy. The volatility has not breached to the upside, and their Treasury is about to do a massive capital raise, which is going to flood the market with new bills. I would assume they're going to do short term. They can't do long term at these rates. It's just that doesn't make any sense, because if you do short term and then they, 1 month, 2 months, 6 months, 1 year, and then next year rates are 2%, 0%, minus 20%, whatever the hell they want to put them at, lower than what they are today, then everything refinances at a significantly lower rate, and you have a significant reduction in capex requirements to service the debt. Um, so that's my expectation that this comes down significantly, and this has a very notable impact on outside the U.S. liquidity. As these bills make their way through financial circulation, they have a capacity to print dollars, printing dollars vis-a-vis issuing credit in the historic Eurodollar banking system, which implies it's done in the U.S. as well. If you collateralize some sort of position with a lender, credit provider, which is a bank, and you borrow against your collateral, that's printing dollars. So, euro dollars just is misleading in that regard. So you can do that domestically in the U.S. as well. But generally speaking, when the volatility on this chart comes down, when this chart goes down, you have an improvement in systemic liquidity conditions. Note that the RRP tipped through the TWAP on the monthly. It's a heck of a chart. Um, and does the Treasury capital raise draw down the RRP? Where does the capital come from? So that is why risk is on the table, and we must cope with the risk. Whether you have chips on the table or not, you're still coping with the emotional reality of potential volatility coming in from every angle at this point. If the capital doesn't come from the RRP and it comes from domestic sources, primary dealers, domestic U.S. banks, or domestic retail, there goes the liquidity, and there goes the potential for liquidity improvements inside of the crypto markets. 129 marginally negative sum on the entire markets, and Ethereum mainnet is marginally negative sum. 69 bill tethers significantly in the lead as compared to USDC, but we haven't seen any significant capital inflow for quite some time. It's been relatively static, which is refreshing in countless regards, and that really indicates to us the destination of where we will be. Capital stickiness is a great indicator for where liquidity will flow when liquidity conditions improve. Capital flows from underperformance to outperformance, and when liquidity is sticky like it is in this market that we're looking at right now on the screen, capital is going to flow here as compared to other places that have been either increasingly volatile or have decreasing opportunity. Back to the charts. Let's move USM2. You're not going to see shit here until things stabilize, and but the directionality, I mean, come on, look at the directionality compared to the start of the chart. The question becomes, this could be years of relatively stagnant domestic synthetic currency supply, but this is really Luke Groman's wheelhouse. How long could domestic liquidity conditions remain restrained without severely and negatively impacting domestic productivity, GDP? And when that starts to hit home, the tax receipts back to the Treasury are killed, and then how the hell are they going to do anything if their income is down? Their business, that's their revenue stream. So all signs point to what Raoul talks about, is where productivity is the only way out of this, barring true incivility, social unrest, and then you just have like society coming apart at the seams. So productivity, they need to juice productivity, and how they do that, we'll see. But they need to get tax receipts up in order to get control of their debt servicing obligations. That's the equation. Tax receipts versus debt servicing requirements. It's just a simple balance sheet of expenses versus income, and it's definitely directionally in a bad direction. Not RSI, meant to compare expectations other markets. Yeah, I got you, Dan, on that one. and I think we hit that pretty good. This market screams outperformance over the next decade. Uh, of all the investments, you when you have capital, you think about where you're going to deploy capital. Do you keep it in cash? And right now, as I mentioned last night on Twitter, I'm consolidating, moving, getting rid of some bank accounts, moving things over to here, and thinking how to manage things. And I'm not screaming or I'm not excited about, well, let me move some more capital over to brokerage and deploy capital to some securities that I do consider. And they don't scream opportunity to me. Opportunity from a capital gain standpoint, and then you got all your tax obligations. I'm not keen on interacting with markets like that anymore. I prefer a very different approach, and I cannot do that approach in traditional finance. And ironically, that approach really is Warren Buffett's methodology. I mean, I'm not going to be able to get the cash flow that I'm looking for, uh, absent, ironically, the volatility I want to endure. The volatility that I have the potential to be exposed to in traditional finance, I argue, or I feel, at this point is much more than what I can be exposed to in the crypto markets as I've structured the portfolio. I could probably get 10, 20, 30% on some dividend bearing equities, but who are your vested interests? Who's the marginal actor? It's a different capital bucket. Different people are participating in those markets, and I don't fucking trust them. I I see for years now the behavior of the specific assets in the specific market that I'm interested in the crypto space, the Ethereum mainnet, and I have a much greater comfortability with exposure to these particular assets than I would having increased exposure to the assets that I monitor and I consider from a traditional equity perspective. I can't find the comfort deploying capital to those markets. Maybe that's the most ironic thing that a traditional financial advisor would hear. They'd be like, I'm significantly disturbed and worrisome, and therefore I don't see it as a good allocation of capital to traditional equities. I see the allocations that we have made and we will continue to make to the very specific parts of the crypto markets as so superior to owning equities, which is just a tokenized company in a database. It's the same thing. It's an instrument to buy that carries properties, and those properties are not exciting nor enticing compared to the properties of the instruments that we own from the crypto markets. Anyway, Samit, hello. When do you think we'll see the liquidity drain from the debt ceiling deal? It depends, as I mentioned at the start of the stream, where it comes from. Liquidity drain could easily come from this $2.16 trillion that's hanging out, just sitting in Fed deposits with the reverse repo market. Uh, Once the deal goes through, they're probably going to have to do short-term debt issuance, that whatever those cash bills they've been talking about, to make sure that they actually have a positive balance in the TGA. And how they manage that, I don't know. Do we see a capitulation, like a significant forced sell-off in equity markets? I mean, the structure of the S&P, we'll do the S&P because Nasdaq is just you know the Nasdaq will respond in multiples. This is like a one-to-one with overall structural liquidity conditions. So the S&P, I mean, I think sees that. Now the question becomes, how do you have a directionality change with barring social civility coming apart at the seams? I don't see it. The government will finance social stability. That otherwise it all comes apart. If this crashes, tax receipts are gone, and the market knows that. So either the market has the system by the balls, or the government what is playing chicken, and they're just going to keep raising rates and crush liquidity conditions to the point where folks need to sell off. I mean, look, the market is buying, so the only reason the market goes through a C wave, which would be huge, down to another hit of the 100 SMA and the monthly, would be forced selling or some sort of capitulation or something structurally breaks in credit markets or the repo markets, like the repo crisis in 2019. And if there's something wrong with lending and something wrong with collateral, that ripples throughout the system with regard to available liquidity, available balance sheet capacity, and it forces organizations to liquidate assets on their books to free up liquidity. It's all about liquidity. It's all about liquidity. I mean, this thing is just up. Now, structurally, this thing looks very dangerous and toppy, but it's the path. And uh, you know, some really good talks lately on Real Vision. Raul was talking to this dude about liquidity conditions. I could find that stream real quick for you guys. You all should watch this one. Let's find it. Let's find it. It's worth it. I was looking at it the other day. Videos. Find Raul's videos. This was really good. The Everything Code with Nathaniel. That was a really good one. But where's the liquidity? Damn it. I don't want to burn too much time, but it's somewhere around here. Maybe you guys know. A couple of folks on the Discord shared with me it, and I found it quite compelling. I would love to quickly find it, but I'm not quickly finding it. I'll post it on Twitter when I find it. Anywho, Dan's in the house. How are you, my friend? Always a pleasure. Thoughts on FPI? You know, it's significant, but inflation, I don't think gets out of control. Too many folks are thinking, it's consumer price inflation. That's the government's measurement of consumer price inflation, and that's the adjustment. But what's more significant to be adjusted for is currency inflation. Consumer price inflation isn't currency inflation. What you want to do is maintain your ownership of your percentage ownership, how much proportional ownership you have of currency in existence. And that's really Bitcoin. Um, but right now, look at the contraction. It's misleading. So let's zoom in. We have a significant contraction in the amount of currency units in domestic circulation. Let's pull it up and get a number. I mean, there's a 5% reduction in currency units in circulation within the United States. So this is not a period where Bitcoin is going to perform well because Bitcoin responds proportionally to domestic liquidity conditions, basically the amount of currency units in circulation. So M2, what triggers M2 to rise? M2 doesn't rise when the TGA does a capital, where the Treasury does a capital raise to refill the TGA. This rises when credit conditions in the U.S. loosen, because this chart is really a manifestation of the general public's capacity to print dollars. This is all deposits. So when you borrow money, when you do this, this, and this, and an additional bank account ends up with a deposit, that's the creation of currency units, and that is what really manifests M2. So you got to see rates come down significantly, and this is why rates aren't the solution to so many things, but rates are also the solution to many things. Rates are not going to change the directionality. We've been struggling over the last year and a half with the lag effects and how long it takes for rates to actually have an effect. And that's why we've been discussing how much control does the Fed actually have, and arguably they have little to no control. It's the indirect control. It's like five 2x4s trying to steer a super tanker. It takes 6 months to make a quarter-inch turn to the left. And internationally, there's almost no control over the dollar market, the dollar printing market, because you could use any form of collateral as long as someone is willing to lend you dollar credits against that collateral. It's the creation of dollar liabilities, and that is the foundation for the euro-dollar banking system since the 1950s. And it's arguably the case that, especially what we're seeing in crypto markets now with the LSDs and the expansion of collateral options, that we're going to see an explosion of dollar liability printing in the crypto markets. It's like Euro dollars 2.0, as some folks call it. And that's quite exciting because the entire world operates on currency expansion. Growth and opportunity are based on currency supply expansion. When currency supply contracts, opportunity evaporates into nothingness. Bitcoin is not the salvation people think it is. While it does respond very well to currency supply expansion, it still is consumed. And that's why, back to what I was talking about earlier, I see the most opportunity is not necessarily in Bitcoin. Bitcoin maybe has marginally more opportunity as compared to some of the equities I look at because we know the directionality, we know the path, and we're assessing the conditions right now to get a sense of short-term volatility that's potentially inbound with regard to circulating currency supply. But how is the destination of available currency units not necessarily upward? It's obviously very upward. So currency supply will eventually resume its upward directionality. This is obviously domestic supply, as Jeff Snyder talks about. Total overall eurodollar supply has been contracting. It's been deflating, not even disinflation. I mean, disinflation relative to like 2008, but short term over the last couple of years, it's been a significant reduction, full on deflation. And that has an impact overall on the planet's capacity to find opportunity. And that's really taken a toll on emerging markets. But, as I've said, even though emerging markets may have access to less capital as available currency reduces outside the U.S., synthetic dollar liabilities outside the U.S., opportunity flows from underperformance to outperformance. So you have a redistribution of capital from the things that are not doing as well with regard to being forward looking. I mean, is crypto not the most forward looking investment opportunity? The crypto space broadly and more specifically, financial products and services that are literally tied right into the very topic we talk about, the creation of dollar liabilities, which in turn, as we've been saying, increases opportunity. This is the ultimate destination for capital by almost any argument that I can make. Which brings us back to there's almost nothing to do. I've talked in the last couple of streams. There's nothing to do in these markets right now but wait. And as I said in this stream's title, cope. Cope with what do I do? What do I buy? What do I sit? Do I wait? Is there going to be a lower low? Stop trying to maximize your opportunity and try and assess the emotions associated with this decision-making process. What's pertinent is that you have a balance sheet, and that balance sheet has a composition. And that balance sheet has a capex requirement at the end of the month. So what you need is a certain amount of liquidity to finance your capex requirements. You should want a certain amount of assets, and you can expect those assets to appreciate and depreciate accordingly. And with the available liquidity you have, you might not need it all for capex requirements. You might want to adjust the balance sheet composition, and optimally, your own personal balance sheet is productive, like an enterprise balance sheet should be. Hope that helps. Thoughts on FPI? We talked about that briefly. I don't know what's going to play out in the future with it. I don't think it's as significant necessarily as folks would hope it to be. According to the narrative of inflation protection, traditionally that's consumer price inflation, what people are referring to, not currency inflation. It really does serve well with regard to that. That's the whole purpose of it, for it to be consumer price inflation protective. But that's not really the most important thing, I think, with regard to our own personal financial management. I'm much more interested in currency inflation protection. And as I've said, owning an enterprise will be currency inflation protective, but also consumer price inflation protective. So the enterprise solution, would really be like an FXS in that type of conversation, also covers what FPI would be protective of. So, the whole point of it is it's an experiment, and where it falls with regard to its ultimate balance sheet significance, we'll see. It's not piquing my fancy too much nowadays. Jesse, you have a good one. Yam in the house. Hard to sit on hands, but cash is a position. Cash is a position. You don't deploy all your cash. You need cash. What if you want to go out to dinner? What if you need extra money? You want to go on vacation? You got to pay bills. You got to go to the grocery store. You need cash. So it's not just a position. It's critical to not spend all of your money. The reason why it's hard for folks to think of investing is because most folks don't have extra cash, and that's a different equation, paycheck to paycheck. And when you need to have the cash and you have to sell assets in your balance sheet, that's an additional emotional consideration that makes it quite the burden to cope. It's very hard to cope with short-term volatility if you're always worried about having to liquidate assets to finance monthly capex requirements. So that's why it is mission critical to have your monthly capex requirements be less than your income, your revenue. And then you have a capacity to make decisions. So, yeah, it's hard, but it's something that's imperative to train oneself to be able to do. I recently deployed some capital. I bought that Ethereum position that folks are probably quite surprised about, but it's something that I was able to emotionally swallow at this point in my career and my journey that I'm on, because I have a balance sheet. I have cash that comes in, and I isolated this to a new wallet. I'm literally staring at it right now, and I'm like, all right, I have more cash coming in. I have assets on the balance sheet. I'm not really too comfortable with other types of assets right now. I'm going to accumulate more cash. I have this quantity of Ethereum. Maybe that's the only composition of this particular account, this particular balance sheet that makes sense for me. Maybe I will become more comfortable with some other types of assets on the balance sheet. I don't know. I think about that all the time. We've come a long way. At one point in 2020, 2021, it was just trading. And 2022, we really went into the productive balance sheet narrative. And look, in 2023, I'm at the point where we've gone a little bit circled around to having assets on the balance sheet that are volatile, that are liquid and can be sold. I still firmly express to you and everyone that the locked positions might be one of the most innovative offerings of the crypto markets, because that is not a position, that is a purchase and ownership. And the question becomes, is that ownership going to survive and prosper and function into the future? And if it does, bought the right thing. Can you please clarify what you mean FXS? I'm unclear what the connection is. Well, FXS is where the revenue goes to for Frax. Now, obviously, it's not incredibly productive relative to other enterprise and the disintermediation of cash flow curve is much more productive, especially with its derivatives like a CVX FXS, 41% APR. It's a remarkable number. Um, but would I acquire the FXS position size I have now in these market conditions? Almost certainly no. It doesn't fit the characteristics I require. It's not as productive as I want it to be, but the speculative potential future for it is extraordinary. It's by far has the largest scope of any protocol in the entire crypto space. I mean, Sam and team are just extraordinary with what they've envisioned and built and moving in the direction of governance decentralization and increased immutability of the contract implementations. It's stablecoin and everything they talk about is quite extraordinary. So how do I reconcile that, the potential future for it versus its lack of short-term productivity? Right now, I wouldn't acquire it. Am I disappointed that I did acquire it? No, that's fine. It's a lock position. It was a purchase. It wasn't a position. Speculatively, it's considerable to acquire it, even though I might say it's not something I have interest in right now. The potential is extraordinary in the future. But now we come back to the equation short term. Are you going to get cheaper prices? And that's why you need to have proper balance sheet composition, cash versus assets in the balance sheet. You can't buy something if you don't have excess cash, so you got to make sure you're spending less than you make. Bottom line, 17 people remaining in the stream, 11 likes. Thank you all for sticking around. I appreciate it. Let's look at one more chart, domestic liquidity conditions. Stagnant. This is on the weekly. And I expect this to be extremely volatile, especially with what plays out with the TGA cap raise. This is going to get interesting. And this is going to directly affect markets. This chart might be the biggest whipsaw because the RRP getting filled is really going to throw this to the downside. And that's something to keep an eye on. And you might get your cheaper prices on productive assets to place on the balance sheet. Curve looks fine. It's quite an extraordinary chart. It's got to be one of my most favorite charts in all of the crypto space. Bottom line, it's an Adam and Eve. It's got a fat inverse head and shoulders. And it screams not down. That's an incredible position to be in considering market conditions. Not down. Not down is outperformance. This is outperforming the markets. And that's quite comforting. So the title of the stream was Coping, and that is definitely something that helps me cope, that this is one heck of a structured chart. In crypto, you got to look past the inflated upside. Like if you do something like this, let's draw a rectangle. Now look at that price range. 30 cents to a buck. Obviously, this was extreme overextension to the upside. It's relatively horizontal, and this is that phenomena I talked about with stuff like Aura. It's a relatively horizontal chart, and that's extraordinary, considering it's an emissions protocol. Whole currency recycling regime conversation aside, there's an increasing supply every second of every day. Yet the price action is horizontal. This is towards the bottom of the range. That might actually mean opportunity because this ecosystem is more robust than ever. The amount of consumers, the amount of third parties financing vote rentals is quite extraordinary. So these things scream fascinating because they're not straight down, and that's comforting. and facilitates the coping process. One curious views in the house. Dan, understood. Thank you. Still waiting for that 100% collateralization ratio before FRX ETH fees go to VEFXS. VEFXS. I believe so. Bear in mind, FRX ETH, the fee mechanic, the interest, the yield from staked ETH goes to SFRX ETH, and that's all distorted because there's 20% of all deposited uh, ETH to create validators have yet to be added to a validator, so there's 20% less yield from the Ethereum network than will be once all validators are spun up. So that's interesting unto itself. I've been meaning to check in on governance just out of curiosity. It's not like it would influence any choices or decisions I have to make. An FXS position, particularly the EFXS position, uh, it's just curiosity, and the market's going to do what it's going to do, and I'm sure it's going to head in the direction I want it to head, so I'm not too worried. I am curious, though. I don't think there's any choices in the short term. CRV USD is capped on its pools, so you can't leverage your SFXS, SFRX ETH in current market conditions. Let's take a look real quick for the fun of it. Let's go back. 9 mil, so I think there's a little bit of capital available to borrow at a 3.42% interest rate. So, look, if you have dollars on your balance sheet, you got liquidity. If you have Ethereum on your balance sheet, you can acquire liquidity either vis-a-vis this mechanic or good old liquidity, which I don't have a site. Was it the DeFi Saver? It's a nice user interface to interact with the Liquidity protocol. Create a trove, put in Ethereum, get out dollars. Can it be any simpler than that? And all you're doing is paying a fee. There's no interest on your borrowed LUSD, and LUSD is relatively expensive. So you're going to get a little bit of premium converting to a spendable stable coin. Nope, it's actually right at peg right about now. That's pretty good to see. So if you have capital, liquid, cash in your balance sheet, great. If you have Ethereum on your balance sheet, you can get liquidity if you need it. And as long as your income exceeds your capex, you have a well-structured balance sheet. And all of this goes back to the point of the stream is we're in a period of coping. There's not much necessarily to do. It's going to be a continued explosion of LSDs. I mean, come on. And then a continued explosion of currency recycler participants joining the Federation, sucking Curve out of circulating supply. I look forward to Curvance coming online. That's something I've been keeping an eye on. What else? There's two protocols that I've been keeping an eye on, which is the Curvance and Prisma. Those are two interesting protocols. Let's take a look at one more chart. Let's see how Bunny's doing. Because Bunny has been paying out significantly. Price is down to 4 cents, about half. I had an entry at about 8. Let's see how it does at this range. It'd be interesting because, we've been talking about the currency recyclers. We haven't seen Federation participants come into this market yet, but there's a significant amount of revenue, and that's quite interesting. So the revenue should be enough to influence actors to want to dry up circulating supply and emissions. And this past week it's at 80%. So 85%. That's quite extraordinary. This is uncharted territory because the primary mechanic for vote rentals from the currency recycler systems like Aura and Curve, That is what incentivizes actors to dry up circulating supply to gain access to that cash flow. Now, this cash flow, I mean, look, you got, nope, yeah, there's a couple of bribes here directly. Go over to the warden. There's some more capital over there. Um, but that's kind of marginal. Does it really matter if a VECRV was getting 85% paid in ETH weekly? Paid weekly, 85% APR, that's over 1% per week. That's crazy. So this is interesting. And I'm very curious to see how this chart pattern plays out. I'm not surprised that irrationality would occur in these market conditions. So I don't know. The chart, you can't tell where the chart's going to go, but the chart tells the story. And if this story holds true, this is very much the bottom of the range with regard to at least post-launch price action. If this continues to range to the upside, as Aura and CRV have done from a price action standpoint, this would be the very bottom of the range. Interesting. Okay, hope that helps everyone. Appreciate all of you. It's a Friday. Enjoy the weekend. Get some sun. 23 people in the stream, 12 likes. Click that thumbs up button. And you know the deal. I'll see you again on Monday after party on Discord for the most rational community in the entire crypto space. Peace.